there tomorrow. So look for the lectures up there. But you can see that for the standard cost questions, I will put this formula on the first page just like this. I'm not going to put it on every page, and so you might have to flip back and forth. For our purposes here today, I also wrote them up on the board, but I'll have them on the actual sheet itself so that you can see the formula there. Unless you guys don't want me to do that. Does that present a problem? Okay, so I'll go ahead and I'll put those up there. Okay, so let's just go ahead and let's see what we have. And for some reason, my mouse always wants to give me some trouble here. But let's take a look at this first one. Let me get us a pen. Okay. And so what do we've got? We've got this, I'm going to use red, I think. We've got this company that produces woven caps, and it takes 2 hours of direct labor to produce a single wall hanging. And the standard cost is $12 per hour. And, oh, it's not caps, it's wall hangings. I don't know why I said caps. I'm like, why would you hang a cap as a wall hanging? But I see it's a woven wall hanging, not a cap. And during August, Bartlett produced 10,000 units and used 21,040 hours of direct labor at a cost of $250,376. What is the efficiency variance? So for efficiency variance, we know we're going to take what? When you go and we can just look at our formula up here, but we would take the standard rate, which is this $12, and then we're just going to use our ninja approach here, which is to say what? We're going to take the standard hours minus the actual hours, and they tell us here what? The actual hours were 21,040. So we take the 21,040, that's sort of given to us, and now we just have to figure out the standard hours, which is what? Takes 2 hours, right? And how many of these things did they actually produce? 10,000? Okay, so they should have taken what? Should have taken 20,000 hours, right? Okay. So what do we got? $12 here times a negative, I think even I can do that in my head. What's that? 1040? Okay. So $12 times a negative 1040 is going to give us this negative 12,480, which is an unfavorable variance. Okay. Okay, good. So again, I think our challenge as we move into the exam here is going to make sure that we're staying as fluent with these as we can, right? And that this can fall apart on you in a hurry if you wait till the night before the exam to, loosen up on these one more time. You're going to have a problem. So the big thing is going to be to keep working these over and over again. But they're pretty straightforward, right? Okay. This one, Prince Company, uses a standard costing system. At the end of the current year, they give us the following information, and they want the variable overhead efficiency variance. And so if I'm doing my overhead efficiency variance, it's going to be what? My standard rate times what? Times my standard hours minus my actual hours. Good. Standard variable overhead rate is $8. And my actual hours are going to be what here? Huh? The actual hours that they use here were 11,000 hours. Okay. Thank you. Okay, 11,000, and what were the standard hours? What were they supposed to use? They were supposed to use 12,000. Okay, so they were supposed to use 12. They only used 11. That's looking favorable. $8 times the 1,000 should give me what? 8,000 favorable, which is the answer here. Okay, oops, I didn't give you. Oh, here it is. It gives it to you here. When you see this, this means I took this from the CPA exam. Okay, so if someone's planning on taking the CPA exam and you're sitting there saying, oh yeah, that's too hard for me, well, there's a question straight from the CPA exam that you would have solved in your sleep practically, right? Okay, okay, good. Come over and let's take a look at this next one using the same facts. What is the variable manufacturing overhead? Well, I guess I should ask you which one I'm looking for now, shouldn't I? Well, since we already had what, efficiency up here? What is this, efficiency? So it must mean that this one must be what, rate variance, I guess? Otherwise it'd be the same exact answer. Okay. Okay, good. So let's go ahead and let's try this one then. So if I'm doing the rate variance, it's going to be the actual hours. Actual hours were what? 11,000. Okay. So it's going to be the actual hours of 11,000. And then it's going to have to be what? The standard rate. Standard rate was $8. Okay, the standard rate we had already picked up is $8. And then we just have to subtract off of that the actual rate. Actual rate is what? We have to pick up the total that they spent. Their total that they actually spent was 90,000. And divide that by what? By the actual hours. So 90,000 divided by what? 11,000? Gives me what? 8.18181, I believe, was the weird number that I got out of that when I did that. Okay, so when I take this 11,000 times negative 0.18181, what do I get? 1999.99 or something stupid like that. Is that correct? 1999 is the answer? Roughly 2,000? Unfavorable? Thus, the reason it's named Prince Company? Okay, never mind. I changed the name of the company after I saw that that number came out to 1999. Okay. Anyway, you guys heard of Prince, right? Okay. All right. Never get yourself in a situation where levity is going to be a necessary element for me to give you any kind of approval, because you're not going to get it. Okay, so number 4, which of the following items would have to be included for a company's preparing a schedule of cash receipts and disbursements for a calendar year 1? I don't know why we need the word year twice, but calendar year 1. And so what's going to be relevant to year 1 here? A purchase order issued in December year 1 for items to be delivered in February year 2. Well, we're going to have to pay for those items and disperse for those in what? Year 2. So that's relevant to year 2, isn't it? Okay. Number B here, dividends declared for November year 1 to be paid in year 2. Well, that's going to require cash in year 2. So far, we're looking for the thing that's going to impact what? Year 1. Okay. Then what? The amount of uncollectible customer accounts for year 1. Uncollectible accounts have no impact on receipts, nor obviously not disbursements. I mean, this is like a no-brainer for disbursements, right? Maybe we might fall for it for receipts, certainly not for disbursements. So, they are asking me receipts. So, but the amount that's uncollectible is ignored, right? For receipts and disbursements. Okay, so the answer is D, borrowing funds from a bank on a note payable taken out in year 1 and agreeing to pay the principal and interest in year 2. Now you look at that and that could get confusing because you're saying, well, you're not going to pay for it for year 2, but we are going to have a cash receipt from the borrowing what? In year 1, right? Right? Okay. Okay, good. Number 5. The controller for Durham Skates is reviewing a product. I think we did this one. But let me do it again because I'm not sure if I had changed it somehow. I know we did this one where the one manager is saying, oh, that was pretty good on a unit of 5,000, but we only produced actually 4,900 units. Okay. And so what's happening here? They're saying that the plant manager believes this is excellent performance on a budget for 5,000 units of direct material. However, the production supervisor is not pleased with the result as he claims to have saved $1,200 in material costs on an actual production using 4,900 units of direct material. The standard cost is $12 per unit. Actual materials used for the month were worth 60,250. So we want the quantity variance, which is what this production manager wants to really focus on. What? How much materials did he use? Okay. So what am I going to do? I'm going to take the standard price is what? $12. The what? The budgeted number of units was 5,000 units of direct material. And this guy's saying, hey, I only used what? 4,900, right? Okay. Is what I actually used. So $12 times the what? Times the 100 units that he saved. He's right, isn't he? He has a $1,200 favorable. Okay. Now let's check out this guy who was trying to brag about how great he did if you use 5,000 as the standard. Okay. Because what's happening? If we wanted to do the price variance, okay, price is what? $12. We're going to take the standard quantity was how many? Standard quantity was 5,000 units. And the standard price would have been 12. Yes, thank you. That's why I give you guys the formulas because I can't ever remember them either. Actual quantity is what? 4,900. Good, thank you. And the standard price, I'm messing my formula all up here, right? Standard price is $12. And then the actual price is 60,025 divided by what? Divided by the 4,900 units. What's that giving me? 12.25. Okay, good. Thank you. And so 4,900 times a negative 0.25 gives me what? Negative 12.25. Okay. So what was happening? This guy was looking at this overall variance of $25, which remember when we said, hey, if you look at the overall variance, the difference between the budget and the actual, you have what? You're mixing apples and oranges. Remember back then when we said because you're combining both price and activity levels that are involved there. And so when we really took a good look at it, we saw that what? Yeah, it's true that we have a negative 25, and yeah, that guy was trying to say that it was good overall, but the other guy was saying, well, wait a minute, if you just look at the price factor, this guy didn't do too well, right? And what saved us is the fact that I was able to save all of these materials. This is why you want to get down to what? To how much of it is quantity, how much of it is price, because then you can isolate a little bit better what's causing the problem. Although, probably this guy, what's the person, the plant manager, probably going to say, well, it was because I bought such great materials that we didn't waste any or something like that, right? This guy will still try to take advantage of the situation up here. Okay. Okay, so you get to a little bit better of an analysis here, obviously, when you do what? Instead of just looking at the overall variance, if you break it out by price and you break it out by quantity, you get a better picture of what's going on, right? Okay. Okay, good. Let's go ahead then and let's take a look at this next one. And a company has budgeted sales for January and February of 20,000 and 25,000 units respectively. Selling price is $5. Purchase price is $3 per unit. Budgeted ending inventory is 10% of the next month's sales. What is and they want the cost of the purchases. Now they're asking me for what? For January? Okay. So the way I do these is I start out always with what I need to meet that month. So if we're going for January and it's 20,000 for January, right? Okay. Then they tell us they're going to have what? 25,000 for February, and they're going to want to have 10% of what they need for February on hand at the end of January. So since it's 10%, I'm going to have to create 2,500 more. So I have what? Remember we were calling this total needs of 22,500? With me so far? Okay. But they would have started the month with beginning inventory of what? Of what they needed for January. They would have started January with 10% of that, right? So they would have started the month beginning inventory with 2,000. So I guess they better produce 20,500. And so if they need to pay what? $3 per is going to give us, what is this, 61,500? Okay. I don't like this multiplying by 3 every time. Some of these things that you see in the solutions, guys, I put the solutions down there. You know, for some reason. I'm not even sure why I put the solution down there sometimes, because I look at the solution and I'm like, only a maniac would do it that way. I wouldn't do it that way. I'd get the units and then I'd multiply whatever I have to. Or if they're telling me that it's 3 pounds and I'm going to have to turn units into pounds or something, I do all those multiplications at the end. I don't sit there and multiply by 3 every single time, because the chances are that you're going to forget to multiply by 3 one of the times, or you're going to hit +3 when you meant to hit -3, and it's just going to be an ongoing drama for you. So make sure that you're, probably doing those where you're doing everything individually, and then go ahead and do the multiplication at the end. Okay, and don't forget the rule here in business BA 101B is that there's no texting or emailing or watching cartoons on your laptop during the class. That's the one rule that it looks like we're going to go down to the last day with that one. So if you think that I'm going to stop enforcing it, think again. Okay? Okay, good. Let's go ahead then and let's take a look at the next question. And they want to say, what is the amount of the company's direct labor? What? Efficiency variance. So if it's efficiency variance, it's going to be what? Standard price of $15, and then it's going to be what? The standard amount, standard hours, and it's supposed to be 1 hour per unit. And so it was how many units? 100 units. So even I can do that one in my head. That's going to be what? 100. That's hours now, right? Minus what? Minus the 110 hours that they give us there. Okay, so $1 times $15 times what? Times negative 10 gives us this. And they didn't ask me favorable, unfavorable, but this would be unfavorable, wouldn't it? It was the only one that had 150 in it. So, okay. Okay, good. Number 8. Which of the following changes would cause a company's break-even point in sales to increase? And if the what? Fixed cost increased? And when I looked at this morning, I couldn't figure out why that was on this test. That would have been good for our first midterm. That is not relevant to what we're going to be seeing on the midterm. So I'm not sure how that one snuck in there. Okay. That's like the question that photobombed its way in here, or whatever they call it. I'm not sure why it's in here. All right. Okay, good. Let's take a look at this one. And they give us the production budget for year 1 is based on 200,000 units of output. Each unit requires 2 standard hours of manufacturing labor for completion. Total overhead was budgeted for 900,000. The fixed is $1.50 per unit, and the variable is 75 cents per unit. Both variable and fixed overheads are allocated to production based on direct manufacturing labor hours, and they give us the actual data, etc. And they want to know what is the unfavorable. They're telling us up front, unfavorable variable overhead efficiency variance. If I'm going to be using efficiency variance, I need what? Standard rate, and it's going to be, and this one's hours, isn't it? Standard hours minus what? Minus the actual hours. Okay, good. Do I have a standard rate? Good. My standard rate is going to be 75 cents, Omar, right? That's because I just look at the variable here. Okay, good. Now, do I have the actual hours that they used? Looks like they used what? 425, right? What should have they used? What should have they used? $352,000. Okay, this is hours, so I don't want to put dollars in there. I've got my price. I've got my dollars right here. Huh? What? 200,000 units was what they were planning to produce. What did they actually produce? How many units did they actually produce? They actually produced what? 198,000? Okay. So if they actually produced 198,000, and then how much were they supposed to spend per each one of those? Times the 2 hours, right? So 198,000 times 2 hours is what? What? 396? Okay. So that's going to be 396,000 hours is what they should have used. Okay, 396 times 425, minus 425 is 29,000. Okay, so does that give me the answer here? Okay. Okay, good. Be careful, guys, because what I was hearing being called out from some of the responses, don't get in a mode where you think you're knowing what it is that you're supposed to use in these questions, and then when you're actually challenged a little bit with one like this, that you start grabbing every number that you possibly can to throw in there. You want to be pretty sure, what numbers you should be picking up out of here so that you can leverage off of that formula being given to you. Okay? Okay, good. Let's take a look at this one. Huh? Is this the woven wall hangings again? Is this the same one? Labor rate variance. Wasn't this the first one we did, or did we do something else up there? Oh, that was efficiency variance. Okay, so we're doing same facts, but now we're doing what? Now we're doing rate instead of efficiency. Okay. Okay, good. So if we want rate this time, then what do we need to do? Is that what they're asking me, rate variance? So we need to take what? The actual hours, 21040 is the actual hours. Okay, good. And it's going to be standard rate minus actual rate. The standard rate is 12. Can I get the actual rate here? How can I get the actual rate? Good. What's your name again, sir? Long? Long, you're saying what? 250,000 you're saying? $21,040. Do you think that this surface has helped you? Do you feel smarter now that you have the surface? So 250,376 minus what? 21,040. You get what, Long? 11.9. Okay, good. So we've got what? We've got 21,040, and you're multiplying that times, looks like a positive 0.10. So that gives us C here, right? Okay, good. How about this one? Parallel enterprises. And we want what? Direct materials price variance. And I have no idea why that's red. If you're like, well, why is that one got that red highlighting? I don't know. This must have meant something at some point. It means nothing now. Okay. So what is this going to be then? We're looking for the direct materials price variance. So we're going to have to take the actual quantity, and in this case purchased and used is the same, but I know I got to put that 150,000 in there, right? And it's going to be standard price minus actual price. What's the standard price? Huh? Okay, well, what am I calculating here? I'm doing materials price. I do that based on the materials I use, right? So I used 150,000 pounds of material. So how much did I pay per? Huh? I paid $2 per. Okay. So I have to take that $2. Okay, good. And oops, that's my standard. What's my actual? What's my actual? 322,500 divided by what? Divided by the 150 gives me 2.15. Okay, good. Yep. Yeah, that's a little odd, isn't it? Oh, um, Direct materials price variance. What did I do here? Well, you get the answer when you do that. I think that's a typo, Omar. This should be what? kg. That should be kilograms. It's a typo. Okay, I'm not going to make you turn kilograms into pounds or vice versa, so don't worry about that. Okay, so yeah, but that's a good observation that what? The units of measure got to be the same. I mean, we can't do this if we got one unit of, well, we could, but we'd have to know how to turn kilograms into pounds or something, and we're not going to do that. Okay, yeah, so that's a typo. Thank you. Okay, so 150,000 kilograms, right, times what? Times negative 0.15? Does that give me this 22,500 unfavorable, I hope? Okay. Okay, good. Okay, let's take a look. Yeah, and see, yeah, okay. So they didn't make the same mistake twice, at least. See how this one, it's the same facts. Now they just want us to get quantity variance, and they were a little bit more careful this time, right? Okay. So let's go ahead and let's take a look. And I can't change the tables. Not that I noticed it, but I can't change the tables anyway on these questions. The tables are kind of locked in, I think. So anyway, okay. So we've got, what are we looking for here? Materials quantity. Okay, so we need what? Standard prices. Materials quantity, we take standard price times what? Standard quantity minus actual quantity, right? So what's my standard price? $2. Okay, good. And what's my standard quantity? Well, what's my actual quantity? Actual quantity we already know is 150,000 kilograms, right? How about my standard quantity? How many units did they produce? 25,000 units. How much stuff are they supposed to use per unit? 7 kilograms. Say it again. 175,000? Like that? Okay, so what do we got? We got $2 times this 50,000? Times 25,000, I mean? $2 times 25,000 gives us the 50,000, right? Was there supposed to be a fire drill today or something? I don't know why somebody downstairs said, oh, there's going to be a fire drill at 10 o'clock, and I've been sitting here waiting for the buzzer to go off, and I don't hear anything, so. I don't know what she was talking about. Okay. I didn't see any emails telling me about a fire drill. Okay, let's go ahead and let's take a look at this one. I'm not going to put on. You won't have to worry about this. Budgets that are periodically revised and have new periods added to replace those that have lapsed. They're called rolling budgets. So every quarter we probably come up with a new budget, and when we do, like at that point, we would roll off, the last 3 months that have occurred, and we add the next 3 months. So we probably do that every quarter. That's called a rolling budget. Okay, so don't worry about that. Okay, good. Number 14. Bengal Company provides the following sales forecasted for the next 3 months, blah, blah, blah. And then they say the company wants to end each month with ending finished good inventory equal to 25% of the next month's sales. Finished goods on June 30th is 1250. And so what are we going to have to come up with for August? And so we know that we're going to sell how many units in August? 5,700. So we know we got to have 5,700, don't we? Okay. Then what happens? Then we want to have some of September's stuff available, which is this 5560. Do we want all of it? No, just 25%, right? So we take 0.25 of that. 5, huh? 1390. Okay, thank you. 1390. So our total needs are 7 what? 7090, like that. Okay. Now this problem was a little different in that they did what? They called out to us what they had available. Okay, since they told us that they had 1250. Oh, no, that's not relevant because what? Hello. June is, I got sucked into their trap. June is not the month that comes before August. July is, right? So they gave me a distractor there. I should ignore this. That's not relevant. I need to get what? I would have had 25% of what? Of August at the beginning of August, right? So 2,700 times, I mean, not 2,700, 5,700 times what? 0.25 is what? 14 what? 1425? Okay, good. So I wouldn't have to produce that because it would have already been available, right? And so does that give me this 5665? Okay. Okay, good. You see how easy it is to get sucked into these? I mean, how many of these problems have I done over the years, and I still almost got yanked in by that information. So be careful with stuff like that, where it's sort of like when you go to park your car and you find a parking spot real easily in a place that there's supposed to be hard parking. That's when you stop and go, what's wrong? And you start reading every single sign possibly around you again to make sure you haven't made that mistake. Okay. Okay, good. Let's take a look at this one now. And they want us to come up with the budgeted purchases. And they want me to do what? Budgeted sales for the month of December, I guess. It could have been a little more clear. I guess we have to be asking for December. So if it's December, it's what? 4,000 units that I know I'm going to have in December, and I want to have what? A desired ending inventory of 2,840. So I've got what? 6,840 is my total needs, but I started the month with what? 1,800. So after I just said that if it looks too easy, there's probably something wrong. This one is okay though, right? Even though they gave me everything here. Okay, good. Let's take a look at this one. And we want what? Materials purchase costs. Okay. And again, well, this one's a little bit weird in that you're going to have to make you're going to have to make adjustments for what? Units versus what? Versus the amount of raw materials you need, because they tell us it's 45,000 pairs of ski boots in the first quarter and 30,000 pairs for the upcoming year. Each pair of boots require, here we go, 2 kilograms of raw material. Okay, so we're going to have to make an adjustment to turn the units into raw materials. Company aims to end each quarter with ending raw material inventory equal to 20% of the following quarter's materials. Beginning inventory for this material is 18,000 kilograms, and the cost is $8. What is the budgeted materials cost for the what? For the first quarter? Okay, so we have what? 45,000 pairs of boots that we want to make. But we're going to turn that into what? Kilograms. So it's going to be 2 kilograms or 90,000 kilograms here. Okay. Okay, good. Then what? We want to end the quarter with 20% of the following quarter's materials. So we're going to want to end with what? Where are you getting 12,000 from? Why am I seeing? I'm sorry. Where is the number 12,000 coming from? Did I hear somebody say 12,000? Okay. Sporting goods manufactured production of 45,000 pairs of ski boots in the first quarter and 30,000 in the second quarter. What is the budgeted materials purchase for the first quarter? Don't I need, for the first quarter, I need the 90,000. And then I'm thinking, what? 30,000 times what? 2, is it 0.2 or 2? 2 kilograms. That's what? 60,000? And then I want what? I want 20% of that? Oh, I see. Thank you. Now I know where the 12,000 came from. So that means that I need 12,000 here, right? Okay. Okay, good. So what does that give me now? Total needs of 102,000? And then they tell me the beginning was what? 18,000? Right? So I can take off that 18,000. I don't have to reproduce those. So 102,000 minus 18,000 is supposed to be what? 84,000? So I take this 84,000 and then how much was it? $8 per? So I turn that into dollars. That gives me 672,000. Right? Okay. Okay, good. Let's go ahead and take a look at number 17. When preparing the cash budget, all of the following should be considered except I don't know that it shouldn't be considered. I mean, depreciation expense is the best answer, but I don't know that it's not considered. It is, I mean, I guess you kind of ignore it. I guess you could say it that way. I mean, the way we were doing it is we were taking the total overhead and then backing out the depreciation portion, right? So we were kind of using it. But clearly, of all of these, depreciation expense would be the one you'd have to choose here, right? There's a problem with these word questions is I don't like them. You know, they're always trying to. The reason we like to ask the word questions is so you can work it quickly, so we can add more questions to the exam. I think we'd be better off if we just ditched the word questions and just gave you less questions on the exam. I guess that would be bad in a way, though, because then you'd be dealing from a smaller base. But I think it'd be good in a way, and that you wouldn't have to deal with a bunch of stupid questions, worded questions. But anyway. Okay, number 18, a plan that shows expected cash inflows and cash outflows during the budget period, including receipts from loans needed to maintain a minimum cash balance and repayment, is called a cash budget. Okay, junior snacks, the total amount of cash expected to receive from customers in what month? In November, and they tell us all sales are on credit and are expected to be collected 40% in the month of sale. So $151,000, right? Times what? 0.4 will be collected. What's that? 60,400, you say? Okay, good. Okay, and then 60% in the month following the sale. So I guess I better pick up what? October's money? 143,000, and I'm going to get 60% of that in November. So that's 85,800, you say? Okay, good. Thank you. And then what about, well, there's you go. There's 100%. So why should I expect to collect anything from October and December? I mean, in November. I mean, well, they don't even give me the month before that, even if I wanted it, right? So, but anyway, I got 100% here, don't I? So I go ahead and I add these two together. What's that giving me? That's 146,200. Okay, good. Number 20. Okay. Webster Corporation preparing its master budget. Compute the budgeted direct labor costs for the first quarter, which is going to be January, February, and March. Okay. And we have our production budget for those months. And each item costs what? 0.6 hours to produce. Okay. Let's just go ahead since I've already shown you the answer rather than have to rewrite it all right there. There's my what? There's my January units, right? And since it's 0.6 hours per unit, then I'm going to multiply the units by 0.6. I don't like to do it that way, though. 2680 times 0.6 is what? 1608? 008? 1608, like that? Okay, 1608 is that number, and then times what? Times the $12, and that gives me this 19296. Okay, good. Then I take 2600 times 0.6 equals 1560, you say? Then times the $12, just to make sure we're all tracking on the calculations here, guys. That gives me what? 18,720. Okay. Okay, good. And then we take the March 2740 times zero point 0.6 equals 1,644 times the $12 equals 19,728. Okay. And then we add all those together. That gives me 57,744, right? Okay. What if they said that they guarantee a minimum of 1,600 hours? Would that change any of these calculations? What would I do? February, right? Right. The 1540 would have to be what? 1,600 in that case. I'm not going to do the multiplication on it. Okay. All right, good. Let's take a look at number 21. And we've got this Flagstaff company, and they're going to produce 7,900 units for July, 8,100 units for August. The direct labor requirement per unit is 0.5 hours. Labor is paid. I think some of these questions I started to pick them just because they were paying the people a halfway decent wage per hour. Is $21 per hour. The total cost of direct labor for the month of what? August. Well, if we're going to produce 8,100 units in August, and it takes what? Half hour per item. What's that give us? 9,500 or 4,500, I mean. 4,050, I mean. Like that? Okay, 4,050 times how much per hour? Times 21. So what's that? 8,000, 85,050. Okay, good. They didn't ask us July, but if they did, that's how we would have figured it out. Okay. All right, good. Let's go ahead and let's take a look at a couple of capital budgeting questions then from chapter, 11? And I guess I better get the present value tables out, right? I guess I can use these. I don't know. Okay, so we're going to close this and we're going to start again since it's going to be stubborn and not cooperate. Okay, that'll probably work for what we need to do here. Okay, all right, so let's go ahead and let's take a look at this question here. And Beaver Corporation is investigating the purchase of a new threading machine that cost $18,000. The machine would save about $4,000 per year over the present method of threading component parts and would have a salvage value of $3,000 in 6 years when the machine would be replaced. The company required rate of return is 12%. What's the net present value? And I'm just going to look at the table here with you. When you go to the answer down here in this table, 18,000 is coming out what? Coming out now, so I don't do any discounting on that. Then what? Then I go ahead and I have this 4,000, and this 4,000 is going to be 6 years at what interest rate? 12%. So I come over and I look at these tables now. Which one do I use? This one, present value of a dollar? Which one do you want me to use, Long? You want me to go to the present value of the annuity table right here? Okay, good. So I'm going to go to what interest rate? 12%. Good. Okay, and I have to find what? Six periods? Okay, so what's that? Is that number that they just gave us, that 4.11 whatever? Okay. Well, the table was there a minute ago, wasn't it? Oh, it's up here. Is the annuity table? No, present value of a dollar. There it is, present value of an annuity. 12% for 6 periods. After all that, it's still not going to let me circle it. There. Okay. All right, good. So we come over, and that's where they got that number, right? Oh, knock it off. What number were we on? 22. Okay, so that's where we got this number. Okay, it's much ado about nothing, isn't it? Okay, all right, good. So there's that number. Um, and if you multiply that times 4,000, I guess you get this 16,444. Is that correct? Okay, so there's that. I'm not sure about that I like the way they've laid this out. The way I would do this is I would put the negative 18,000 in the way they did. That's what they have to pay today for that thing. And then we've got a positive coming in of this 16,444. Okay, at present value. And do I need to discount anything else? They're going to do what? They're going to pick up this $3,000 of salvage value. Okay, but that's a what? That's a one-time amount that comes back to salvage value. We don't use the annuity for that because that's just one payment. Hello? Guys, do we need to do this? Are we wasting time now, or what's the deal? Okay, so this 3,000 times what? 0.507, which is going to be what? 12% is the interest rate. And the number of periods is what? 5.0663. Is that the number they had there? .07, close enough. Now it's going to jump back to the beginning of this file for no apparent reason. 5.077 is pretty close, right? For question 22, right? Okay, and so when they go ahead and discount that, they get this what? This is the worst layout I've ever seen of an analysis. Is that the 152 here that they get? Okay, so that's the 152. Just taking that 3,000 times that factor we saw there, that's going to come in at the end as a one-time. We went to the present value of $1 on that. And does that give us this negative 35? Okay. Now, would you invest in this project? You wouldn't. Yeah, you probably would anyway. I mean, I'd look at it and I'd say that's close enough. I mean, I'm wanting a 12% return, and it got me pretty darn close. But in a textbook, the answer would be no, right? In reality, you'd probably go for it. Okay. Okay, good. Let's take a look at this. Frick Road Paving is considering an investment in a curb forming machine. The machine will cost $180,000 now, and they're still using that same funky presentation. So I'm going to do it like this: now versus what? Future. That's the way I like to do this. So now is this 180,000, right? And then what? It's going to be a 10-year project, and we'll have a salvage value of 30,000. That's in the future, though, isn't it? Okay, so we need to turn that into our present value factor we got to pick up for that to bring it to now. So the present value factor, which table do I go to? Which table do I go to? Present value of $1 table. Okay, and it's what, 10 years at 10%? So when I come over to the tables, present value of $1, 10% is here, and I've got what, 10 years is 0.38554. Okay, so I come over and I take a look, I'm going to multiply that times this 0.358. What factor did they use, just so that we get the same answer? They use 0.386. Close enough. That gives me what? 11,580? Okay, good. And that's going to be an amount that's going to come in at the end of this thing, right? Versus the 180,000 that's going out now. Okay, and then they tell me that I'm going to get cash inflows of how much per year? 40,000. So there I have to go present value of the annuity table, right? So you come over present value of the annuity table. I know it's an annuity because all the numbers are bigger than 1. That's my problem, is the annuity table came first. I keep thinking it came out. No, it did come after. There it is. Present value of an annuity for what? 10%, 10 periods is 6.14457. 6.14457. Okay, so I come over, they use 6.145, that's fine. I'll pick that up. 6.145, they say. Multiply that, so the present value of that 40,000 is 200 what? 45,800. Okay, that's an inflow. So this is going to have a pretty nice little positive net present value of what? 77,380. Okay. Okay, good. Let's take a look at question 24, right? Okay. And they want to know the net present value of this project. So we have the cost of the equipment, so we're going to set it up the same way. Now versus what? Future. 50,000 is coming out right now, right? And then in the future, well, we also have a working capital requirement coming out now. And again, I'm never sure why they have a working capital requirement that gets tied up. I don't know, some sort of deposit or something that we're going to have to be using here. But that also comes out now, doesn't it? Okay. Then what? No salvage value. Annual cash inflows are in the future, aren't they? So that's going to be 20,000 in the future. I've got to come up with the present value factor for that. 8 years required rate of return is what? 20%. Now that means that I can't use those yellow tables here. I'm going to have to go to the green tables. And again, I don't know who decides what factors are to be shown on which tables. I'm going to write a letter to Trump and ask him to standardize these and to include all interest rates, no skipping interest rates. Like what? 22% is not a legitimate, rate of return. I don't know why they jump from 20 to 25. Okay, and so what happens? We come down 20. How many years? 8 years, you say? And 8 years is what? 3.837, right? 3.837. Okay. So I go back to the problem. Is that what they used? Okay, good. They used the same factor. 3.837. 20, 24. 3.837 times the 20,000 gives me 76,000 what? 740. Okay. There's that. Anything else? Do I have to do anything else? Do I have to do anything else? The salvage value, not salvage value, but what? The working capital does what? It gets released at the end of this, doesn't it? So even though it goes out now, it comes back in the future, right? Back to the future. Okay. It comes back in the future, and so I need to multiply that times what? 3.837 is an annuity. This is a one-time release back, right? Okay, so I need to do what? Present value of $1 for, what was it, 8 periods? At interest rate of 20%. What's that? 0.233? 0.233? Okay. Let's see if I can get it to not jump all over creation here. 0.233. Okay, good. They use the same factor. 0.233, so that gives me, when that 30,000 comes back, 6,990. Okay. So now you go through, you've got this negative 80,000 cash outflow. You got 76,000 coming back. You got 6,990 coming back on a present value basis. That gives me what? 3,730. Right? Okay. That's fine. Close enough. Huh? I don't care. Okay. I'm not going to get into rounding discussions. Okay. Okay, good. Let's take a look at this Galindo. And they want us to come up now with what? The internal rate of return. Now remember, internal rate of return is a rate of return that will do what? That will cause this present value to be 0, right? The net present value to be 0. Okay? And so net present value is 0 when what? When the amount of the initial outflow, which is 178,848, equals what? The present value of the inflows, and the inflows are going to be this 36,000, right? Won't that make the internal rate of return 0 at 12%? Okay, so I sit there and I just need to find this present value factor. Well, how do I find the present value factor? I take the 178,848 and I divide it by what? 36,000, and that gives me 4.968, doesn't it? Hello? Okay, so then I have to go back to the tables. And should I do present value of $1 or present value of an annuity? Present value of an annuity, good, because this is a stream of payments. And how many years did they say? 8 years on this thing. And so I come along the row here until I find something that's close to that 4 point. Oh, thank you, God. Look at that. Isn't that beautiful? There it is right there. 4.968 is 12%, right? So this one worked out perfectly, didn't it? So the answer here is what, 12%? I think that'll be the case. Oh, God. Yeah. No, they're going to have some parts of a table there for you. You'll be able to actually have to memorize the table. Yeah, if you memorize those tables, then you'll be in good shape. Yeah, they'll give you, Omar, I'm sorry, being sarcastic, but they'll give you some means of doing what we're doing here with the tables. Okay. Um, this question was contemplating that you had the whole table there, but they'll have to give you something to allow you to do it. Okay, so it was 4.968 was 12%. Lined up with 12%. Okay, good. Let's take a look at this one. Internal rate of return now. And well, let's set it up again. I don't know that it's necessary, but well, it doesn't hurt us to think through the logic again. So if my net present value, the internal rate of return is the rate of return that caused my net present value to be what? 0, right? So I have to do what? I have to take my cost, which for this machine is this 310,464, and that has to be equal to my net present value, which is going to be the present value of my cash inflows, right? And my cash inflows here are what, 84,000? Okay, good. So I go ahead then, and I just want to come with that present value factor. And so 310,464 divided by 84,000 equals what? 3.696. And that's 3.696 how many years? 5 years. So I go to the present value of the annuity table, 5 years, and I run my finger along until I find what? 3.696 is what I was looking for. Now I'm in between what? 9 and 10% here, right? Okay. Oh no. I mean 10 and 12%. Oh, I see the problem. If this stupid, don't say it, John, table had 11%, I think it would fall right on 11%. But this stupid table decided that 11% was a number that it had to stay away from because the evil spirits that are contained in prime numbers would have attacked it if it had 11% on it. So let's go back to this table. 5 years and at 11%, that gives me the 3.696, right? Right here. Why would you skip 11%? What's the deal? What's annoying about that table is it skips 11%, but then it does something stupid like gives us 23%. Watch. Oh no, it doesn't. I thought this was the one that gave us 23%. Okay. All right, I don't know. Stop, John. Okay. So, let's go ahead and let's take a look at this next one. Oh, okay, we're going to get into some absorption costing questions here in a minute, but I want to take a quick break, and we'll continue on. You just want to continue on like this? Go through as many of these as we can. We got about 50, so we're a little over halfway there. Okay, so let's take a quick 10-minute break right here, and we'll come back and we'll start up with these absorption costing questions and continue on through the chapters that way, okay? All right, guys, I'll see you in a couple minutes. Okay, so we're going to start to move into some questions now regarding absorption versus variables costing. And remember, guys, the major takeaway between the two methods is how we treat our fixed manufacturing cost, right? Okay, under variables, we're going to expense them. Under absorption, we're going to what? Keep them into inventory until those items are sold, in which case they go out as part of our cost of goods sold, right? Fixed manufacturing cost is the big difference. So which of the following statements regarding absorption costing is true? All manufacturing costs go to be what? Go to be product cost. Our materials, our labor, which of course are both variable, and what? Our manufacturing overhead, both our variable and our fixed manufacturing overhead, right? If this was variables, the answer would be that what? Fixed manufacturing overhead costs are not treated as product costs, they're treated as what? As period cost, right? Okay. Okay, good. Let's take a look at this one now. They say that under number 28, under absorption costing, a company had the following information when 9,000 units were sold, and they want us to pick up the cost using the product cost using what? Production cost using variables costing. And so I'm going to go ahead and pick up, do I pick up the direct labor? Pick up the direct labor. Do I pick up the direct material? Those are both variable. Do I pick up the variable overhead? I pick up the variable overhead. How about the fixed? Do not pick up the fixed manufacturing overhead. And so if you total those three, we get this 2075. Okay. If this is absorption, what do you want me to do? I pick up the what? 725. Good. What else? Do I pick up the $8? Yes. Pick up that $8. Good. Do I pick up the variable overhead? Yes. Yes, I do. So I'm going to pick up that 550. So far the answer is the same, right? Anything else I'm supposed to do? Huh? How many units did I produce? Huh? I produced 25,000 units, right on? Okay, so you still want me to pick up that 750? 750 was at what? At 9,000 units, wasn't it? So what do you want me to do here? At 25,000 units, huh? You want me to take this, what, $67,500, and you want me to divide it by how many units? 25,000 units. There we go. Now we got a fixed cost per unit, don't we? Of what? 270? Okay, 270 per unit. Okay, good. And you add all that up now, and that comes to what, 23 something? What is it? 2345? Okay, good. Okay. All right, good. So there's the difference. I mean, that's going to be the theme here. And there we go. That was the next question, right? The way I would work these questions when you're studying for your exam, write this down. I would work these questions if I'm asking you absorption in the practice question. When you get on your test, you should do what? I mean, when you're practicing with these, when you're studying, you should do what? Variables, right? If I ask you variables, do absorption, and there's a chance that by doing that, you will have backed into actually working a question that you're going to see on your exam, right? Okay. Who are these new faces that I've never seen before in my class? Where are these people coming from? Maybe I've got Alzheimer's and I'm meeting new people every day. Okay? All right. That's what my dad says about Alzheimer's. He said, you know what's good about having Alzheimer's? I said, No, what, Dad? Because he doesn't have it. He thinks he does. You get to meet new people every day. Okay, Dad, that's not funny. Okay, all right. So let's come over to number 30 here now. Okay. I didn't think it was funny. He thought it was hilarious. Okay. And let's take a look at number 30. And we say that during its first year of operations, the McCormick Company incurred the following manufacturing costs: direct materials, etc. And they want the value of the ending inventory now using what? Variables. Now it's their first year of operation, isn't it? And if they produced 25,000 units and sold 20,000 units, well, they tell me, this sounds familiar, they end up with 5,000 units in ending inventory. Did we work something like this already? Because I remember saying that before, that I thought I was going to show you this great thing about how you know what was in ending inventory. And then they just tell us there's how many units in ending inventory? 5,000. So now I just have to go through each one of these, and I have what? Direct labor of $5. I have what? Variable, should I pick that up? Of $3. Direct materials of 5, direct labor of 3, and then variable overhead of what? $4. Should I pick that up? Okay, get that. How about the fixed overhead? Don't care about that, right? Not, at least not for this problem. Okay, so I've got what? 5,000 times, what's that, 12? Or 60,000? Okay. Okay, good. What if it's absorption? Do I pick up the $5? Do I pick up the $3? Do I pick up the $4? Anything else? Now I pick up that 250,000, don't I? And divide it by what? Divide it by the units produced of 25,000, right? Good. So what's that giving me? $10? Okay. And so I add all that up now, and that gives me what? $22? And I can do that one in my head. Times what? Times 5,000? So it would be what? 110,000? Okay, good. And, okay, yeah, okay, that's it. Okay, all right, good. Let's take a look at this one. C Company reports the following information regarding its production cost, blah, blah. Compute the product cost per unit using what? Variables. Am I going to pick up the $35 for labor? Am I going to pick up the $28 for material? Am I going to pick up the $17 for variable? What do you want me to do with this fixed? Like they say in New York, forget about it. Don't worry about it. Okay, so that's what. That gives me 80. Okay, good. What if it's absorption? Take the what? Take the 105,000. Divide it by what? 42,000 units. What is it? 2.5. Onto that. Like that. So it's 8250. Okay, good. What was that the answer to the next question? No. No, but it is one asking me about what? Absorption, right? Okay, good. So if I'm dealing with absorption now, Do I pick up the materials cost? Hello? Okay. How about the labor? How about the variable overhead? Since they're asking me per unit, we're getting disappearing numbers here. Don't know why I got numbers disappearing on me. We got what? We got 9. We got what? We got 11. Okay, good. We're using absorption. What do you want to do with the variable overhead? 75,000. Got to divide it by what? 25,000? What's that? $3? Right? Anything else? Fixed is what? 137,000. 137,000 divided by what? The 25,000 gives me 5.4. 5.5. Okay, good. And I add it all up, and I get what? 2850. Okay. Okay, good. Let's take a look at this one. Let's see if we can do net income under absorption. Okay, so my sales price is what? $50 per unit? And I guess I have to look up at the previous problem. I'm like, how many units did they sell? I guess it must be up here. They tell me they sold how many units? 15,000 units. Right? Okay. So it's $50 per unit times what? $15 per unit gives me 750,000? No. $750, right? Not thousand. What am I doing here? Oh, 15,000 units. Sorry. Okay, let's start over on this. $50 times 15,000 units. That's the 750,000. Okay, good. Okay, then what? How about that's my sales. What about my what? Cost of goods sold? So I'm using absorption, right? Am I using absorption? So should I pick up my cost per unit, my product cost per unit here under absorption? Is that what that was? Cost of goods sold would be the cost per unit times the number of units I sold, right? Okay. So I take that 2850 times what? I sold 15,000 units. That's going to give me what? 127, 427,000? Like that? 500? Okay, so what does my sales minus my cost of goods sold give me? No. Contribution margin is my sales price minus my variable cost. I've got some fixed cost in there, don't I? Good. That's my gross profit. You're going to have to know all these terms, guys, to answer a question like this, right? So 750,000 minus 427,500 gives me 272,500, you say? Like that? Okay, that's all right. 750 minus 427,500 gives me 322,500. Okay, good. And then they tell me that my operating expenses are 200,000. So if my operating expenses are 200,000, I guess this company didn't have any non-operating costs like interest or anything. Frankly, they should have been more careful and not just called it net income. They probably should have called it operating income, but that's okay. I won't yell at them too much for that. That's what, 122,500? Okay, good. Let's do it for variables, which is what's right here, right? Okay. I'm going to do it the short way. I'm going to do it the long way. Well, I'm going to do it both. First, I'm going to do it the long way. Long way is going to be what? Sales is still what? 750,000? That didn't change. How about my cost of goods sold? Huh? Now it's going to be what? Now it's going to be $23 per unit. Did we calculate that at some point for this problem? Oh, I guess we didn't, did we? So let's just go ahead and let's make sure we know where we got that. That $23 is going to be what? It's going to be the materials. It's going to be the what? Labor, and just the what? Just the variable portion of the overhead, right? Which was what, $3? And so that's where we got the 23. 9 plus 11 is 20 plus 3 is 23. Hello? Okay. So 23 times how many units? 15,000 units sold is going to give me what? What is it? 345,000? Now, Omar, I don't know what you'd call this number. I can't call it contribution margin because this problem isn't telling me of those operating expenses that they're just throwing into this problem, which are variable and which are fixed. So I can't even call this contribution margin. I don't know what you call this. You call this a test stupid number that means nothing. Okay, the difference between these two. Okay, because if for me to call contribution margin, I'd have to have all the variable cost up there, and I don't know which of those selling and administrative is variable in this problem. So I can't call it contribution margin. But what's the difference here? I'll call it number X here. Huh? Say it. 405,000? Okay. So I've got this 405,000. Now I need to sit here and do what? Take off the operating expenses of 200,000. So my operating expenses are 200,000. That's 200,000. And then you say you want me to do what? Now you want me to take the fixed overhead because we are using variables here, right? And the fixed overhead was this 137. We take all of it, don't we? Just going back up to the problem. 137,500, right? We're going to take that whole amount. Okay. So we go ahead and we back out that whole 137,500. And we end up with what? 67,500 as our net income. Okay. Okay, good. Now, why is that not working? $50 minus 23, then 15,000 minus 200,000 minus 137 gives me 67,500. 122,500. Oh, yeah. The difference now is what? Is going to be the fixed manufacturing overhead that's still sitting in inventory. If I sit here and I look at these numbers over here, they produce how many units? 25,000? The fixed manufacturing overhead per unit is what? 550? Right? Fixed manufacturing overhead per unit is 550. They produced 25,000 units, but they sold what? They sold 15. So that means there's 10,000 units sitting in ending inventory that still have the fixed cost contained in them. So if I sit here and I take what? What was it? 550 per? How many units? No, it's not 15,000. It's 10,000 units that are still sitting in inventory, right? I get what? 550 times 50? 55,000? And if I add that 55,000 back to my absorption, I should get 122,500. Right? That's because there's those 10,000 units that I didn't sell yet that are still carrying their fixed cost in what? In ending inventory. Well, under variables, it got expensed already, didn't it? Okay. Okay, good. Okay, any question on those for now? Okay, good. What do we got, like 14 questions to go? 10 more to go? Okay. I thought I had 50 questions. Oh, really? Darn, I thought I had gotten more questions than that. Okay, let's go ahead. Let's take a look at this one then. This one I just took it out of the problem section, so it didn't have multiple choices, which, by the way, I'm of the opinion that when you work these questions on your own, you should just cover up the choices, the multiple choice choices. They're not there to help you. Who do those multiple choice choices help? Me, because then I can give you a multiple choice exam and I just run it through the Scantron to see if you got it right or not. And if the Scantron goes, they got it right, that's good. Or it'll sit there and go, they didn't get it right, as it goes through and scratches through as it puts all that ink on your paper. But it doesn't help me. So I thought, well, one way I can get you some additional questions here is to give you one that don't have the multiple choice choices, right? And see if you can get it still. Okay, so let's go ahead and take a look at this one. And first they ask for the return on investment, and then they ask for the residual income of this investment center. Okay, so what happens? I take the net income and I divide it by the average invested assets, and that gives me a 15% return on investment. Now, they didn't give me a bunch of choices here, but on the exam I might say 10%, 11%, 12%, 15% would have been the right answer, right? Okay. Then they say, well, what's the residual income? Well, if their target income is 6% of the invested assets, 6% of 2,100,000 is going to be what? This 126,000, and they actually had net income of 315,000, so they have 189,900 residual income, right? And on the exam, they're going to sit there and they're going to say, 100,000, 200,000. Right answer is going to be what? 189,900. Residual income. Okay. Okay, good. City Park College allocates administrative costs to its teaching departments based on number of students enrolled, while maintenance and utilities are allocated based on square foot of classroom. Based on the information below, what is the amount of expenses allocated to each department if administrative costs for the college were $180,000, maintenance costs were $70,000, and utilities were $85,000? So they're going to do what? They're going to allocate the administrative by the number of students, and they're going to allocate the what? The maintenance and utilities on size of classroom, which is kind of silly because I would think different disciplines would share different classrooms, but whatever. Okay? Okay, good. So we come over and let's just see how we're going to do this. And so first we'll do the administrative, which is based on what? Based on students. So we pick up that $180,000 that we're going to allocate, and we add up the number of students, right? There's a total of 780 students. This is the world's smallest college, I guess. 780 students. And then we sit there and what? 117 divided by 780 should be what? About 15%? Yeah, it's 15%. Okay. 156 divided by 780, I'm thinking should be about 20%. Yep. Okay, and so on. I'm not going to do all of them. We'll go into a coma over here. Okay, but we go ahead and we do what? We do those percentages, and then for each one of these, we take the administrative cost and multiply it by the percent. So 180,000. That's 180,000 times the 0.15 should give me 27,000, shouldn't it? And then 180,000 times 0.2, even I can do that in my head, is going to give me what, 36? And so on, right? Right? So we've allocated all these costs, and you're saying, well, which one's the right answer? This is not a multiple choice. I mean, this would be what you would be expected to do, is hand in an answer in which you have gone through and systematically done all this, right? Hello? Okay. Okay, good. On your exam, I might just ask you for the electronics department, or I might just ask you for the computer department or something, but you're going to need to sit there. And I might ask you, total cost for the electronics department. So far we've got what? 27,000, don't we? But you then have to realize that, okay, but to get the total for the electronics, now I got to do what? Now I've got to pick up the now I've got to pick up what? The maintenance and the Utilities, which are based on size of classroom, I'm going to have to allocate that. If I'm trying to get the total electronics, I'd have to allocate that to the electronics now, wouldn't I? Based on number of classrooms. Okay, so I come over, and you see that that's what they do down here. They pick up the maintenance and the utilities, whatever. So now we have 155 that's going to be allocated, and they're doing that based on the size of the classrooms that they got up there. That's the 900 for electronics, 750 for automotive, etc. They add all of that up. Shouldn't automotive be more than anybody? And I add all that up, and I get a total of what? 3,000, don't I? Okay, so I now take what? 900 divided by 3,000. Is that this 30%? Okay, and I go ahead and I multiply 30% times 155,000, and I get 46,500. And then I do the 750 times the 3,000, and I get what, 25%? And I multiply that times the 155,000 total there, and that should give me this 38,750, right? And so on. Okay, and so when you look at this, and probably the way you'll get asked this on your test is I'll just then call out electronics, let's say. So you'll have all that information, and then the multiple choice question will say, how much should be allocated electronics? And you're going to have to know then to add what? The amount of administrative that we had up there that was based on students, plus the amount that we just allocated of the maintenance and whatever this other thing was, utilities, based on numbers of classrooms or square foot of classroom, whatever, and we're good to go, right? Okay. Okay, good. Let's take a look at number 38. Menswear, major department store, sales of 180,000, cost of goods sold 132,500, indirect expenses 13,500, direct expenses 27,500. The menswear department's contribution as a percent of sales, well, let's get its contribution first. Contribution, Omar, is what? Sales of 188,000, good. Yeah, good. Minus the cost of goods sold is going to be this 132,500. Now we're not looking, I probably shouldn't have called you out because you're thinking I'm asking you contribution margin, which actually they're just asking the total contribution of this division, right? But this number right here is what? Still gross profit, isn't it? 188 minus 132,500 is 85,500. 55,500. Okay. Okay, good. And what else? No, not yet. We want the total contribution to overhead as a percentage of sales. Should I pick up these indirect expenses? No. Should I pick up these direct expenses? Pick up the direct expenses of 27,500, right? And that gives me now how much? Huh? 28,000 even? Okay, good. Then, Omar, I take the 28,000 and I do what? Now I divide it by the 188,000, and that's going to give me this percentage, roughly about 14.9, I guess. Okay, so the takeaway here is what? When you're figuring out the contribution of a division, a department to the overall contribution, the overhead of the overall company, you do what? You subtract out direct costs. You what? Ignore the Indirect costs. You don't allocate those, right? Okay, good. Frederick Company is thinking about having one of its products manufactured by a subcontractor. If Frederick can buy the 5,000 units from the subcontractor, it should it make or buy the product? Okay, so how are we going to evaluate this? We could buy it for 130. Do you want to make it or buy it? Well, if you make it, do you still have to incur the 62,000 of direct materials? Okay, so it's going to cost me 62,000 to make it. Do I have to incur the 47,000 of labor? Huh? Going to have to incur that cost. Okay, good. Will I have to incur the variable factory overhead? I'll have to incur that. Will I have to incur the factory overhead? I mean, there's nothing in this problem that's indicating to me that that would go away, right? In order for me to not consider that as part of this decision or to make me decide whether want to use it or not, I'd have to say those costs would be what? Would be eliminated as a result, or those costs would be avoidable. And sometimes we saw some problems where they'd say half of them would be avoidable or something. We'd only take half of them, but here they didn't tell me anything. So that's what, 52,000? What's that all add up to? 199,000. So I should do what? I should buy these from the subcontractor, right? I mean, I'm not saving anything by making these things. Actually, I think I'm doing this wrong. What's the 62,000 plus the 47 plus the 38? I think that's also more than 130,000, right? I think I did this wrong.
It's 147.
Yeah, that's the way to analyze it, guys. I'm sorry. Because the 52,000 is not relevant. The 52,000, I got it, it doesn't matter, right? I just want to consider the costs associated with what? With doing the option of making. Okay, and so it's going to be what? All the variable costs associated with making, not the what? Not the fixed factory overhead. I'm stuck with that, right? Regardless. Okay, but still, it does what? It gives me a cheaper option to buy it, right? Than make it. Guys, I mean, you can read these on your own. I mean, if we want to do it this way, I don't want to sit here and speak to the wind. So you just want to do these on your own? There it is. There's the answer. This is the 147,000. Okay. All right, number 41. This is the last one we're going to do. Paxson Company can produce a component of its product that incurs all the following costs per unit: direct materials, direct labor, variable overhead, fixed overhead, and we say an outside supplier has offered to sell the product to Axle for 32. Compute the incremental cost or savings by buying the item. So right now this is costing me what? Do I have to pay the direct materials? Got to pay the 10 for direct materials. How about the direct labor? Got to pay the direct labor. Okay. How about the variable overhead? Got to pay the variable overhead. Good. How about the fixed overhead? That's not relevant, right? I'm going to be stuck with that no matter what. So I add all these up, and that's 24, 27 versus the 32. So if I go ahead and I make these units, that's what's going on here. It's cheaper for me, right? I save $5 per unit. Okay, all right, let's stop there because I don't feel like we're gaining anything by continuing to go through these. Maybe what I'll do is I'll put these on the mock midterm for you. Okay, so you'll get exposure to them that way rather than me sit here and just keep talking. Okay, so next time, hang on guys. Next time, what I need you to do is look on Canvas. I guess I'm going to have to get this done so you can look at it tomorrow night because I want you to print the thing. I don't want to sit here and have to print off 50 copies of the test to give to you. So you're going to have to print the thing and bring it to do the mock midterm. We'll do on November 30th. That's next time. So look for it on Tuesday night, fairly late because I need time to do it. So I'd say, 10 o'clock or so. Look for it and it'll be there. Okay, and then you're going to have to print it and bring it. Don't worry about Scantron. We're just going to mark it right on the test itself. You'll be able to take the test with you, and then we'll come back on Monday the 5th. We'll correct the test. Discuss the test, and then we'll turn December 7th into sort of an open office hour that I'll just sit here, and if people want to come up and ask or you want to ask questions out loud, however, that's how we'll do it as we get ready for the final. Okay? Sound like a plan? Okay, guys. Have a good rest of the day, and I will see you on Wednesday. Look for that thing Wednesday night. Tuesday night. Wouldn't do us much good Wednesday night.